Hi guys, you're welcome to Flockie's Den. If you're new to this channel, please click the subscribe button and don't be left out of the tribe. It's every week that we post new videos. You don't want to miss out on any. And to my returning subscribers, thank you. I appreciate you coming back over and over again. Today I'm going to be talking about personal finance. Yes, how to manage your funds, especially as new immigrants. As many people that are desiring to land into Canada, it's good that you make good and informed financial decisions. And this is what we're going to be talking about today. So stick around, guys. So the ability to make informed decision is key here in Canada. And if you have come in from your country, newly landed or about to, it's important that you understand how finance works in Canada. Every cent counts here. There's no free money. You work for every dime that you make. So it's important that you know how to manage your funds and also spend them. Okay? So if you have brought in your POF, that's your proof of funds from, back in your country, you would have been expending it on your rents, on groceries, on upkeeps, whether you're buying food or clothes, and you need to make some income to be able to manage those funds, right? So I'm going to be sharing with you how you understand money and how it matters in a society like Canada. Here in Canada, the currency is minted by the Royal Canadian Mint and is in different denominations, in coins and in notes, also of different colors. It's also important to know that the currency has nicknames which Canadians used to call those monies in their everyday life. For instance, the 5 cents is called the nickel, the 10 cents is called the dime, the 25 cents is called the quarter, the $1 is called the loonie, and the $2 is called the toonie. Those are the coins, and we also have the notes, which are of different colors and all of the same sizes. And they are produced or printed by the Bank of Canada as well. So for the notes, we have the $5, which is color blue. The $10 is purple. $20 is the green color. $50 is red in color. And the $100 is brown. So banks and credit unions are safe places whereby you could deposit your money. Your money is safe. And in Canada here, you have a right to a personal bank account, even if you don't have a job, even if you have a bad credit rating. If you were even bankrupt before, and if you don't even have money to put in that account, right away when you open the account, you have a right to a personal bank account. For instance, if you open an account for your child who is under 18, you just have to become like a second beneficiary to the account. You can open a child's account. Then when the child is 18, then they transfer the ownership of the account to that child. Like in other countries, here in Canada, we have the checking account, so we have the savings account, and we have the business account. For your checking account, it's an everyday account, so you use it to pay your bills. You receive your check or your salary into your account. General transactions, day-to-day transactions, you run on this checking account. On your savings account, this is where you can save. You can decide to save. It can be a subset of your checking account, whereby you can move money from your checking account into your savings account if you want to save some money for the rainy day. So on that particular account, you have interest accrued for the money that you actually deposit into it. And if you're running a business, you have another account whereby you open, whether it's incorporation, limited liability, it's a business account. So that is separate from your daily running expenses or personal accounts or checking account. It's called your business account. It's also important to note that here in Canada is a cashless society whereby transactions are made without carrying cash, even though, well, some people still ask you to pay cash for little things that you make, transactions that you do. But most of the time it is a cashless society. So it's either you use your debit card or your credit card or your check for your transactions. I know we're all familiar with having a debit card or a check when we have to pay using a checkbook. But I just want to mention what a credit card is and what it does to you as a Canadian that use it, okay? A credit card is a loan. The bank, when you open an account, can give you a credit card if you ask for it. Sometimes, if you don't want it, they will not force it on you. But if you ask for it, they will give it to you. And if you're a new immigrant into Canada, you also have opportunity to receive a credit card. And a credit card is a loan. Guys, it is a loan. But it helps you to build your credit rating and the ability for the bank to loan you money. So if you get a credit card, you spend your credit card, you have a cycle to pay back what you have spent on that credit. And then most of the banks that I know always get their statement out about the mid-month, and then you're expected that whatever you have spent before that mid-month, you are expected to pay it in the early days of the new month. So if you do not pay, you get charged interest on that expense. And you don't want this to continue. Otherwise, you're making it difficult for the bank to loan you money because they will say you're not creditworthy. And then there's the ability for you to also check your credit score, even from your bank app. For some banks, I know you can do it on your app. Others, you have to go on the system to open your account on your computer to be able to check your credit rating. When you have a 700 score, then you're good, but you want to have a better credit score, which will also help you when you're going to be, asking for, loan or mortgage loan. The bank gives you a credit limit. So, for instance, the bank can give you 1,500 credit card or 2,000, and they would increase it based on your credibility. When they know that you spend and you pay back, they can increase that credit for you because they know you have the capacity to pay back. And don't forget that it is a loan. It is just there for you to be able to access and pay back. So many people don't even want the credit card because they don't want to get into more debt, because you'll be tempted to spend what you do not have. But you have to be disciplined enough to know that when you spend, you have to pay back. And when you pay back, you're building your credibility with the bank or any financial institution at that, and then your ability for them to also lend you more money. Credit cards also come with interest charges. For instance, if you fail to pay back what you spend in the payment cycle, you get charged an interest. And most of the time right now, it is about 19.99%. And you don't want that coming on you, right? So it's important for you to spend. And then from your debits or your checking account, you want to move whatever you are spending back into your credit card to nil off your expenses. That's always a safe way to do it. Also in the bank, based on your ability to pay and your credibility, like I mentioned, you have opportunity for a line of credit. And a line of credit is also a loan, guys. It is also a loan. And it's like you're moving money into your checking account from your line of credit. And the beauty or the benefit of this is that the interest rates are lower, between 6 to 8%. But it's important that even despite the limit that the bank will give you, if you don't spend it, you don't pay, right? Because you have not used it. So for whatever amount you've moved into your checking account or you've spent, you get to pay interest on it, but it's lower than you using the credit card. The bank also gives what is called personal loans, which is an expense that is major that you want to embark upon. For instance, mortgage, it could be you want to buy a car, you want to, maybe furnish your home, major expenses. So those are like one-time expenses, which is huge, and then you approach the bank for such an expense. So if you are granted the loan, you have to sign an agreement with the bank and with terms and conditions following, repayment terms monthly, and then for a period of years applicable. Okay, depends on whatever terms that you agree with the bank. There are also some other kinds of loans which you can also benefit from. Other stores, furniture stores, also give you, they have like a card based on your credit score, because they're going to do a search on you and then see how credible you are. Based on that, they will give you a cap or a limit for like the credit card is a credit card as well, which helps you to purchase furniture, appliances from their store, and then enables you to pay over a period. Sometimes they give you like a 2 years, even interest free. Those are the catches, and people jump right in. But you need to be careful, because there's nothing that is free, guys. You just have to be wise when you're making these informed decisions. It is financial. It has a record that is going down on you through your sin, and then you must be able to know the implications of every step you take when it comes to financial matters. But if you know that you're capable and you have the capacity to be able to pay this over a period of 2 years or more or less, then you can go for it, because it's also very easy and convenient to pay a loan when you stretch it, rather than dropping all the money at once. Guys, there are other things to spend money on rather than just trying to buy a furniture or fit up your house and you're paying $10,000, for instance, at once. Let's talk taxes. As a Canadian or a resident of Canada, we are all expected to pay taxes to the government. These taxes are in three folds. There's a personal income tax, there's a sales tax, and there's a property tax. Your personal income tax is deductible from source. It's paid out of every paycheck that you earn. The employer deducts it and pays you the net of your income. And this personal income tax is subject to your annual income. It depends on whatever you earn, and then the percentages differ. For instance, if you earn less than $30,000 per annum, your personal income tax is lower than the next bracket for people higher than that. So you can when you earn more, you pay more in taxes. When you earn less, you pay less. And even when you're earning less, you have other benefits because you're earning less. So it's important that you understand that taxes are paid irrespective of who you are. You pay taxes when you make an income or through your paycheck, and then the percentage will just differ because of the income bracket that you fall into. So if you are already earning like 100,000, your net income at the end of the year might just be around 65,000, for instance, because your tax will be high. The deductions that you have are also subject to your dependents. That is how many children that you have. And this also, will be calculated in such a way that you can have money back because of, your annual income, for instance, depends on whatever your annual bracket is, and then your dependents and their ages. You can have income back from the government, such as child benefit, and it also would vary depending on the age of the child. There's a way it's calculated. If you have a younger child, you earn more on that child than when they grow up. And then when your child is 18, the government stops paying them because already they are a grown man, like my son that just turned 18. So there's no more child benefit on him anymore, because now he gets to file his own tax. He can't file tax under us anymore. He's now an adult in that sense. So filing your tax annually would determine, based on so many criteria, your refunds or whatever the government will be paying you back on. If you are within a low income bracket and you have younger children, so many scenarios that play out here, then you might be getting a bit of refunds. If you're also in a high income bracket and you pay a lot of tax, you also be getting income back, but you'll be losing out on the child benefit, because if you earn more, you won't be getting as much of what you should receive from the government based on child benefit and some other benefits that also accrue to you. Also, talking taxes, like I mentioned, we also have the sales tax. And in the sales tax, guys, anything you buy in Saskatchewan, we pay 11% tax. We pay 6% as provincial tax and 5% as sales and services tax. That's like the GST. It's also part of some of the things that are benefits that are paid back to citizens quarterly. This is paid quarterly, like 4 times in a year. That's your GST. And everybody gets to pay 11% tax. Whatever you're buying, you're paying tax. 6% for the provincial, 5% for the goods and services. As a low-income earner, the government refunds these taxes back to you. Like I mentioned, the government encourages or recognizes that you are low income and they want to always support. So if you're low income, you get support from the government. You still pay your sales tax whenever you make any purchase, the 6% and the 5%, but you get it refunded back to you when you file your tax. So the next kind of tax is the property tax, and this applies to those that own houses. So if you have a house, you bought a house in Canada, you are required to pay property tax, and this tax is dependent on the value of the house that you purchase. Since we're discussing finance, let's also talk about investment. On the flip side of finance is also investment, right? And if you're talking about investment, is looking at how to make money while you're in Canada. So we have different ways in which you can increase your income or wealth here in Canada. Number one, we have the RRSP. That's the Registered Retirement Savings Plan. And on this program, it helps you put money aside towards your retirement. Retirement age is about 70 here, and you want to keep money aside because obviously when you get to that point, you can't really work to earn as much as you can right now. You want to put money aside, and this is done from your annual income. Every month, monies are taken, deducted, and put in your RRSP. And that way, you're putting money aside for retirement. Even most organizations, when you join, they help you to do this particular task. It's a dual contribution between the employer and the employee. And the employer will deduct 6.5% from your paycheck, while they also contribute the other 6.5% for your registered retirement savings plan. There's also the RRSP, the Registered Education Savings Plan. Here you want to put money aside for your child's education in future. The earlier, the better. Education is free up to high school, grade 12. But as soon as your child is going into college, you're going to be paying yourself. So some children here in Canada they can stop at grade 12 and start working. But if you want your child to go further in the education, you want to invest in this by whatever you have saved already from the RRSP, and then you be able to match it up if you have some other personal savings on the side, right? But with the RRSP, you can always put that aside till your child is ready to spend it. And on this RRSP, the government matches these amounts as well. So in a year, depending on how much you put, the government matches that amount and adds to the amount, and then you can withdraw and then be able to pay, and it's tax-free. You can open your RRSP with the bank, that's for your child's education, or you can do that with an independent provider. There's more income when you put it with an independent provider because it's invested in high yields. You get high returns for it. Then the government matches this amount that you have, whatever amount you have. There's a way the government matches that amount, and it's good for you, right? You increase it faster than putting it in the bank. No grudges with the bank, but you can always get more money when you invest in other providers away from the bank. The tax-free savings account also enables you to be able to save, and is a far better option, like I would say, because you're not paying tax on it, right? It is tax free. So why not put your money where you don't get taxed? And then you can also use it when you're filing your tax. Every year, the government has an amount, like a cap to how much you can save. But guys, it is a lot of money that you can save. Except you earn so much, that's when you're going to reach that cap. You need to protect yourself from fraud or fraudulent people, because like they are everywhere. Even right here in Canada, in fact, they send text messages to you, they call you. Some will even tell you that they are from the government of Canada, and start saying scary things for you, that they would ban you or things. But don't get involved in any fraud, and that's the way you can stay clean. The most important thing is that you guard your SIN. I mentioned that the SIN is like your passport. It is your identity. When you lose it or you expose it and someone picks it, they can perpetrate fraud, and then you get into trouble. Or they can use that to clear up your account. They can use it to just get you in real trouble. So you want to keep your SIN, that's your social insurance number, dear to your heart, the next thing closest to your chest. You don't want to call it to anybody on the phone. Like when we came, they will tell you, you don't give it out, don't tell anybody. You have to be careful. It's like, don't put it don't put it on the internet. Don't, you just have to be careful so that you don't get scammed by exposing your SIN out there. Apart from your SIN, you must be careful not to just willingly give out other information about you, such as your credit card number, which anybody can also use to perpetrate fraud. If they get hold of a credit card number, they can spend money from it, and then you get in trouble to pay that money back. So you don't want to give that information out there. Here, there's a protection with the bank. We use emails to send money, not even the bank account number. So if you want to transfer money to another person, you just ask for the person's email address, and that's already associated with the bank. So that's the form of exchange, right? So you don't expose your account. You want to guard your bank information so dearly. You also want to guard your driver's license. You don't want to lose it, because you cannot afford to drive without it. If you get stopped, your ticket is double because you are driving without a driver's license. So you must also be very careful. Then your passport. Guys, keep it with all of your heart, your might, your soul, and your strength. Don't get it missing, guys. Otherwise, you will get in deep trouble. So guys, with these few tips I've been able to share about banks, investments, your finance, credit card loans, and so much more, and how to also increase your income, and also how to save. I believe you'll be able to make informed decisions based on all of this. Be safe, and don't let any fraudster lure you into anything whatsoever. Thank you so much for staying up to this time. See you again in another video. Bye guys.